What if I told you that the greatest threat to your financial future isn't a stock market crash, it isn't a recession, and it isn't even your spending habits? It's something far quieter, far more systemic, and it's happening right now, whether you're paying attention or not. Today we're pulling back the curtain on the Federal Reserve, money creation, and the inflation story the headlines aren't fully telling you. The Fed's balance sheet. Let's start with a number. $6,155,000,000,000. That is the size of the Federal Reserve's balance sheet as of December 31st, 2025, and it represents roughly 95% of what the Fed holds. Now, fast forward just under 3 months to March 25th, 2026. That number has grown to $6,271,000,000,000. That's an increase of approximately $120 billion in less than 90 days. Roughly $40 billion per month, on track for nearly $500 billion per year. And this is before conditions deteriorate further. So what is actually happening here? Let's break it down. To tell how money is created. The Federal Reserve has a unique and extraordinary power. It can create money digitally, instantaneously, and inject it into the financial system. This isn't a conspiracy theory. It's documented, public, and confirmed by the Fed itself. Here's the mechanism. The Fed creates new money and uses it to purchase U.S. Treasury securities, bills, notes, and bonds. In doing so, it effectively lends money to the U.S. government. From January to late March of this year, Treasury bill holdings increased by $148 billion. Treasury notes and bonds rose by an additional $33 billion, a combined $181 billion in new purchases, with a net money creation of around $120 billion after accounting for other balance sheet changes. The Fed may call this reserve management or portfolio rebalancing, but functionally, it is money printing, new dollars entering the system backed by nothing but future obligation. Why is this happening? Here's the deeper question. Why is the Federal Reserve doing this? The answer lies in a structural problem facing U.S. government debt. The United States currently carries approximately $39 trillion in national debt. When fewer investors, domestic institutions, foreign governments, global funds, want to purchase U.S. Treasury bonds, demand falls, and when demand falls, the government must raise interest rates to attract buyers. But higher interest rates on $39 trillion in debt create a staggering costs the government simply cannot absorb. So the Federal Reserve steps in as what economists call the buyer of last resort. It purchases the debt itself using newly created money and keeps rates from spiraling out of control. This is the quiet engine driving much of what we're about to discuss. Peter, what about inflation? The official Consumer Price Index, the CPI, currently reports inflation at 2.4%. But let's examine what that number actually measures. CPI does not simply track whether prices have gone up. It uses a method called substitution. The logic goes, if the price of one item rises significantly, consumers will switch to a cheaper alternative. And the index reflects that substitution rather than the raw price increase. In practice, this means if something that cost $100 now costs $110, that's a real-world price increase of 10%. But if CPI determines you could instead buy a substitute for $102.40, it reports inflation of just 2.4%. This methodology has real consequences for how we understand purchasing power. Meanwhile, the M2 money supply, the broadest commonly cited measure of money in circulation, grew by 10.6% in a single month. When the money supply expands at that pace and prices are reported rising at only 2.4%, that gap deserves serious scrutiny. The larger picture. Let's zoom out. Beyond the Federal Reserve's balance sheet, there are additional stresses building in the financial system. Private credit markets are showing signs of strain. Commercial real estate continues to face serious headwinds. Banks are carrying assets of questionable value. The system, as it currently operates, appears to require continued monetary expansion to function, not because policymakers want inflation, but because the alternative, a sudden contraction in liquidity, risks triggering cascading failures across credit markets and government financing. This is the difficult calculus at the center of modern monetary policy. A controlled, gradual inflation may be seen as preferable to an acute financial crisis, but that calculation has a long-run cost. Each new dollar created dilutes the value of every existing dollar. The US dollar has lost over 96% of its purchasing power since 1913, the year the Federal Reserve was established. That is not a short-term statistic. That is over a century of slow erosion, compounding quietly beneath the surface of everyday economic life.